It's Robert Rotherham from KPMG, for those who have just arrived. Assuming you can all hear me, I'm not speaking into a void, then I think we'll make a start. So thanks to everyone for joining us for today's webinar, which is the third in this current series of KPMG's weekly webinars. It's going to be a tax series focus today. Those who joined us for previous webinars will know that we've already covered issues such as the Isle of Man governance response to the pandemic, cash flow management, liquidity, and other business continuity matters. If there are specific areas you'd like us to cover, then I just encourage you to contact any of the other KPMG team members and myself, and we'll try and factor them into any upcoming seminars. I must say, it does continue to feel a little bit odd doing these things remotely. Certainly feels nothing like standing up in front of you all at the Claremont, where we normally run our tax seminars. It does at least save me from having to explain where the toilets and the fire escapes are, so you should really know that for yourselves if you're all at home. I do have a little bit of housekeeping to do though first. If you're having problems with the connection, then please just hit the reconnect button at the top of your screen, and that should refresh you back into the webinar live room. Secondly, please do feel free to ask questions as we go, either in the sidebar or by email to webinars@kpmg.co.im with the word question in the subject field, and we'll try and address these either at the end of the section or at the end of the webinar. Okay, with the housekeeping out of the way, I'll move on to today's agenda. There's going to be three presenters today. There's going to be myself, I'm a tax director here at KPMG Isle of Man, David Parsons, our tax partner, and Claire Kelly, who's one of our senior tax managers. Today's session is going to be focused on corporate tax related issues. We do separately intend to run a session centred more on personal tax matters in a few weeks' time. In terms of agenda, I'm going to start by briefly describing HMRC's position as concerns the effect of the current pandemic on UK corporation tax residents and permanent establishment matters. I'll also summarise the OECD's progress as regards its twin pillar approach to the challenge of taxing the digital economy. Dave's going to go next and bring you up to speed with economic substance developments, including any potential COVID-19 impacts on companies' positions. Then Claire's going to run through the key points from a practice note issued recently by the Income Tax Division on the subject of Isle of Man company tax residents. And then Claire's also going to provide a quick update on all things FATCA and CRS. Finally, Claire's going to hand back over to Dave, who's going to summarise where we're up to on the Isle of Man's mandatory disclosure rules, and he'll also wrap things up. Okay, on to the presentations proper. So COVID-19 is obviously the thing on everyone's mind at the minute, not least HMRC, who've dealt with concerns raised about the effect that the pandemic might have on company residents and permanent establishment matters by issuing what are meant to be reassuring updates to their published manuals, and specifically their international tax manual. So firstly, what are the concerns here? Well, from a corporate tax perspective, they're twofold, but are based on the same potential problem, which is that of people being stuck in a particular place where perhaps they wouldn't typically be, at least not for an extended period of time, and they're effectively stranded there until further notice. If someone like that's performing employment activities in a country other than that in which their employer is based, then prima facie there's a risk they might create a permanent establishment or taxable presence of their employing company, particularly where they're performing value-added or fee-generative activities. And the consequence of having a permanent establishment in a foreign country is that the employing company might then have to allocate a proportion of its profit and thus pay local corporate taxes on that amount. So obviously something to try and avoid if it's all possible. Most countries consider a permanent establishment to exist in two main situations. Firstly, where a foreign company has a fixed place of business there, and secondly, where a foreign company has a dependent agent in that country, who both has the power and also habitually exercises that power to carry out the foreign company's business there. And the sorts of situations this typically applies to is whether somebody enters into contracts on behalf of the foreign company. Now, HMRC's view of the potential issues posed by COVID-19 in this respect is that essentially existing legislation and guidance already contains sufficient flexibility to be able to deal with any resultant changes in business activities. And specifically, they've emphasised that a non-UK company shouldn't automatically have a UK fixed place of business as a result of fairly short-term changes in circumstances. And that's because the very term fixed place implies some degree of permanence. Equally, a dependent agent PE would only arise if that agent were to habitually conduct business on a foreign company's behalf. And again, a short-term change in practices might well not meet the definition of habitually. So whilst this is pretty reassuring stuff, what it doesn't deal with or acknowledge even is what might happen if things last as they are on a more longer-term basis. Certainly stopped a long way short of providing a blanket exclusion for changes to business practices brought about by COVID-19. That's something which I'm sure businesses would have welcomed, given that the focus is understandably going to be elsewhere for the foreseeable future. But as I say, the guidance doesn't quite go that far, at least as yet. As I mentioned, there's also scope for company residence risks to arise. There are certain jurisdictions, and the UK is included, where dialing into board meetings physically held somewhere else, or even making decisions outside of board meetings, runs the risk of the company in question being deemed to be centrally managed and controlled, even if only partially from that jurisdiction in which the person dialing in or making the separate decisions is physically located. This might mean that the company is deemed to be tax resident there, and again, this is something you very much don't want, as the possible result is that it's then subject to tax in that jurisdiction on its entire worldwide income and gains. So how have HMRC responded to concerns raised about this risk from a UK perspective? Well, very much in keeping with their approach to the permanent establishment risk. The basic position is that the existing rules and guidance are able to cope without the introduction of special measures. HMRC have pointed out that the guidance does already make it clear that they'll take a holistic view of the facts of each case. Interestingly, their COVID-19 update spells out that they won't necessarily consider a non-UK company to become resident in the UK just because a few board meetings are held there, or because some decisions are taken in the UK over a short space of time. As far as I'm aware, that's the first time they've ever expressed those sorts of sentiments, albeit HMRC do go back to linking that back to their existing examples of where they wouldn't typically challenge a company's resident status. And those examples themselves are conditional on certain background facts being in existence. Those background facts are unlikely to be present in a good number of situations. And so I guess all I would say is that caution needs to be exercised if you're trying to seek to apply these comments in the context of any real life situation. So in summary, the guidance, which is contained at page 261010 of HMRC's International Manual for Permanent Establishments and 120185 for residence matters, is certainly worth having a look at if the pandemic has the potential to cause you these sorts of issues. Just don't expect it to offer you any kind of wholesale reassurance. It's still very much a case of having to take everything in the round. Okay, if we can widen the lens of it now to more international matters, we shouldn't forget that the OECD are continuing to progress their work concerning the taxation of the digital economy. This work's fallen out the back of BEPS, which I'm sure you all know by now is the OECD's flagship base erosion and profit shifting project, and it's been split into two pillars. Pillar one is all about where the profits of multinational digital businesses should be taxed. Of course, lots of businesses are digital in some way or other these days, but the focus here is primarily on those businesses that derive significant revenue or have significant user activity in jurisdictions where their physical presence and thus their tax base is fairly light. The term GAFA companies has been bandied about, being an acronym for Google, Amazon, Facebook and Apple, and it's really these kinds of companies who the Pillar 1 work's aimed at, albeit not exclusively. The central concern is that the current rules don't seem to allocate profit with any real weighting towards where customers, or users as the case may be, are based. And so Pillar 1's trying to tackle that problem. There's some very complex issues here which need to be solved, and the challenge is to solve them in a unified way. You might recall that some countries, and the UK is one of them, have introduced unilateral measures, so-called digital services taxes. And the OECD is keen to ensure that these don't proliferate, and what's more, that those which have been introduced are quickly repealed once an international consensus has been reached. The other challenge is perhaps more of a political one. The GAFA companies and some other big groups who are likely to be most affected that tend to be US-based. And the US government's been making noises that Pillar 1 is essentially just a way of eroding the US tax base. Now, the US is still very much part of this process. They've not walked away from it, but the OECD did see fit in January to issue a statement confirming that they're seeking to bridge the remaining differences, so very much implying that there is some work still to be done here. In terms of timings, a lot of the design work's been done already and been consulted on, and so assuming that those political differences can be put aside, the aim is to agree the key features by July and then have a detailed report issued by the end of the year, albeit given the current situation, that timeline might be a little bit optimistic. Pillar 2 isn't really about the digital economy per se. It's relevant to virtually all businesses and can best be described as a minimum tax rate initiative. The initiative's been encapsulated in the OECD's GLOBE proposal, GLOBE being short for Global Anti-Base Erosion, which in very brief terms is designed to ensure that irrespective of the level of tax incurred by a particular company in a particular jurisdiction, those profits are ultimately subject to tax at a certain minimum rate. This is a kind of belt and braces for BEPS, as it's designed to eliminate any residual opportunities for multinationals to divert profits to low or no tax jurisdictions that the wider BEPS project hasn't got round to dealing with yet. There's, at this stage, a huge amount of uncertainty as to how all this is going to look in practice. And the minimum rate itself is one of the things that's yet to be agreed. I suspect that might be one of the last items finalised, but the early indications are that that's going to be in the 10 to 15% range. I have covered the design options at a tax seminar we held at the end of last year, and those that were there will remember that the overall impact on the Isle of Man will probably depend on a couple of the other areas of uncertainty, and one of which seems to have become slightly less certain since. And the two areas of uncertainty I'm referring to are, firstly, the scope of the proposal in terms of the size of the groups to whom the rules will apply, and secondly, the level at which a group will need to blend its taxable profits and tax liabilities in order to establish whether a top-up charge to that minimum rate is required. There hasn't been an awful lot of progress in this latter area, but what does seem to be becoming apparent is that the size threshold for inclusion within the proposals is likely to be in line with that applicable for country-by-country reporting rules. And those familiar with the country-by-country reporting rules might recall that this means that only groups with turnover of in excess of 750 million euros look like being in scope of these rules, at least initially. But I would say that design of Pillar 2 is still very much in flux, and given its potential importance and application to the Isle of Man and other low and no tax jurisdictions, it's definitely something we need to keep an eye on. Although, given the timescale on Pillar 1, this is probably going to lag a little bit behind it, but we'll keep you posted. Okay, unless there are any questions for me, I'm going to pass over to Dave.
Thanks, Rob. No, I think you've escaped so far, so that's good. So I'm assuming everybody can hear me okay. No doubt people will shout up on the chat if they can't. I'm just going to talk for the next 15 minutes about substance. And I guess, if we look back 3 months or so, economic substance legislation was in many ways dominating the attention from a local tax perspective. Many companies, particularly sort of corporate service providers, were starting to move towards business as usual across their portfolio of clients. And in particular, as they headed towards the first round of tax return filings under substance. There'll be others that perhaps have been a little bit slower off the mark for various reasons, and we're still assessing the true impact of the substance legislation on their own activities and assessing what their next steps needs to be. Now substance is a webinar in itself, or perhaps many webinars. So I'll take the liberty of just plugging a webinar that the ACSP will be putting on the 14th of May, which I think will be advertised shortly and which I will be presenting at. So feel free to participate in that. So the purpose of today is to give a few topical reminders in relation to substance. Now, as we all know, I should hope, that it applies to accounting periods commencing on or after 1 January 2019. So for your classic 31 December year end, we're now into the second period that's in scope of the rules. And that's important, particularly from a company that is failing to meet substance, and when I start to talk about penalty implications a little bit later. The rules apply to companies that are in one of 9 relevant sectors. If your company is clearly in scope, for instance, you're in the insurance sector, you're a bank, you're a fund manager, I'd like to think that by now you're fully aware of your position. But there'll be other companies out there that may still be grappling with their status. Watch out for those companies that have got interest-bearing loans and are inadvertently financing leasing companies, and equally for for companies that hold intellectual property, particularly companies in the software area, there are some tricky questions as to whether a company is or isn't an IP company for the substance rules. If we just look at a blacklisting for a moment, I mean, the reason I mention this is the whole reason that we introduced this substance regime is frankly because of the threat of blacklisting of our jurisdiction. So we moved quickly from mid-2018 onwards, and we've seen companies that have moved between so-called grey lists and blacklists, and that continues to evolve. Probably many of us have been frustrated by the apparent time delays in updated guidance coming out of the tax authorities, both here and elsewhere. And indeed, we've seen jurisdictions that have introduced the substance rules starting to sort of compare and contrast their rules with those of other jurisdictions, trying to see perhaps where another jurisdiction has been perhaps a little more relaxed or a little more business friendly, and assessing whether or not perhaps the jurisdiction could change their rules. And I think the EU and the OECD have become very aware of this and very aware of the risk of jurisdictions backtracking on what they committed to do in a way that could undermine the process. So in October 2019, the EU Code of Conduct Group came out with a statement that basically said, if a jurisdiction amends its legislation or guidance, having not previously effectively pre-cleared those changes with the authority, then if the Code of Conduct Group then considered that change to be harmful, they would immediately recommend blacklisting effectively. So you can see why, and we've seen some incidents in the likes of Cayman, you can see why the tax authorities and the income tax division here are very, very cautious about issuing new guidance and making any amendments to legislation without being clear of the consequences before they do it. And in terms of consequences, it's worth just dwelling a little bit about the consequences of blacklisting, because it should not be underestimated. This hasn't yet fully played out, because obviously we're only just coming into this regime and we're only just starting to talk about blacklisted jurisdictions. But the EU published a range of measures that member states can take in regard to interactions with entities in blacklisted jurisdictions. And these include requiring non-deductibility of costs and payments to entities in blacklisted jurisdictions, higher rates of withholding tax than would otherwise apply on payments to entities in blacklisted jurisdictions, application of controlled foreign company rules where your subsidiary is in a blacklisted jurisdiction where those rules would not otherwise apply, and denial of participation exemption on dividend income where those dividends come from blacklisted jurisdictions. So those are all very serious consequences, and some of those blacklisting measures have a degree of interaction between what's happening under the sort of Pillar 1, Pillar 2 measures that Rob has talked about. But it's worth saying that the Pillar 1, Pillar 2 measures, and the Pillar 2 measures in particular, are aimed at the largest companies. Those companies with 750 million euro turnover is probably where that will end up. Whereas blacklisting is jurisdiction wide and will apply to all entities in that jurisdiction. So it's very severe and therefore must be avoided. If we look at, for a moment, about COVID-19 and the impact of COVID-19 on substance, a number of jurisdictions have come out with relaxations in relation to substance rules because of problems caused by COVID-19. So, for example, Jersey came out in writing quite early on saying that if a company had to adjust its operating practices because of COVID-19, then that will not be considered to result in a substance failure in a situation where a company was otherwise meeting the requirements. So the most obvious example of that would be physical attendance by directors at board meetings. So obviously, non-resident directors clearly can't travel to the island at the moment to attend board meetings. And so Jersey has come out with explicit guidance saying that won't of itself mean that you fail substance. Now, the Isle of Man hasn't come out with an equivalent statement to say that attending board meetings virtually will be okay from a director to managed perspective at the moment. But I think it's pretty clear that they will be pragmatic when the dust settles on all of this. A few words about penalties. I mentioned that we're in the second period now for many companies of the substance rules. And so the thorny question of penalties is becoming increasingly important. You'll also probably be aware that the penalties for substance failures are severe. The lowest penalty is £10,000 for a year one failure for a non-intellectual property company, rising through 50,000 and up to 100,000 for a year two failure on a high risk intellectual property company. So these are substantial penalties, and much higher than from a tax perspective we're used to seeing in the Isle of Man. And for a long time, there's been a hypothetical debate as to, what will the income tax division do if company A fails substance in scenario B? And the division had not yet formulated its policy. And I think the division were finally starting to formulate their policy, realizing that it's now becoming very, very relevant since the new format tax return came out from 1 January this year, and then COVID-19 arrives. And so the truth is we do not yet know what the division's stance will be on penalties. But I'll give you an example. Company A has a 31 December year end, fails substance in 2019. We're now partway through 2020, and Company A is still failing substance. The directors and shareholders have assessed the position of Company A and have taken the decision to get rid of the company. They're going to kill it. They're going to liquidate it, stroke dissolve it. And that will happen in the next month or so. So the company will have failed substance for 2 periods. And on the face of it, it is facing penalties of £10,000 and £50,000. Now, those penalties may or may not be material to that company. But the question is, will the division impose penalties at that level? Well, on the one hand, the tax office will want to be seen by the EU and the OECD to be doing the right thing. On the other hand, they achieved their ultimate sanction here, which is strike off, because the company is going to be killed. So why would they want to sanction the company further? As I say, the bottom line is we don't yet know what the division's attitude is going to be, what their stance will be on penalties in this position. But I'd like to hope that they will be lenient. And I think they very much recognise that the legislation was late coming, in the sense that the legislation was published late 2018 and was effective, with a month later. And the latest guidance was only published November 19, So, and they recognise that it takes some companies time to make decisions. So as I say, I think the situation I just described, I'd like to expect that they would be lenient on penalties. My only caveat to that would be that if you've got a high-risk IP company, particularly one that's got significant value of IP on its balance sheet, I think they may feel that their hands are more tied in terms of how lenient on penalties they can be. And bear in mind, the penalties for high-risk IP companies are 50,000 year one, 100,000 year two. If we look at some future developments, at the moment, as you will probably be aware, collective investment schemes, funds, are outside the scope of substance in the Isle of Man, whereas fund management is a relevant sector for substance purposes. The following pressure from the EU and the OECD, the Income Tax Division intend to bring forward regulations that will bring self-managed schemes in scope. So these are schemes, collective investment schemes, that are structured as Isle of Man resident companies and that basically don't have a fund manager on them. It seems clear that will have some probably limited impact on those schemes, or in terms of the number of schemes caught. Exactly how those substance obligations will be imposed, I think yet remains a little unclear. The second one is partnerships. At the moment, our substance rules only apply to Isle of Man resident companies. But in November 19, the EU Code of Conduct Group published an update on their work in which they made it very clear that they expect partnerships, or at least partnerships capable of separate legal personality, to be fully within the scope of substance. So the Isle of Man has not yet done this, but had it not been for COVID-19, I would have fully expected that by the end of this year, we would have amended our legislation to bring at least limited partnerships, Isle of Man limited partnerships, into scope. Quite what the impact of COVID-19 will be on the timing of that introduction, I don't know, but I suspect it will happen sooner or later. And then the final point in terms of future development is the question. Clearly, the Income Tax Division need to come up with internal guidance on how they will impose penalties in the types of situations I described earlier. Question, the unknown from my perspective is to what extent they will publish externally their approach on penalties. And with that, that's me finished. I don't know if any questions have come up that need to deal with. If anybody, Rob or Claire, can tell me.
No, not yet, Dave. So we'll pass over to Claire.
Okay, thanks.
Thanks, Dave. Good morning, everyone. As Rob mentioned, the first topic I'm covering today is an overview of how to make an Isle of Man incorporated company non-Isle of Man tax resident. I will refer to the introduction of the substance rules. The number of companies that we have seen wishing to become non-resident has increased significantly. This is on the basis that the Isle of Man substance rules only apply to Isle of Man resident corporate taxpayers. However, I would highlight from the applications that we have seen, the reason for this increase to become non-resident has really been driven by companies formalising their actual position, given that they have already been dual resident for a number of years, rather than for any avoidance reason. Before I talk through how an Isle of Man company can become non-resident, I thought it was worth setting out that a company will be tax resident in the Isle of Man if it's either Isle of Man incorporated or centrally managed controlled from the Isle of Man. Obviously, where a company is centrally managed controlled in the Isle of Man, it's easy for them to change their residency status by changing their operations such that the company is no longer centrally managed and controlled from the Isle of Man. For Isle of Man incorporated companies wishing to become non-resident, the position is a bit more difficult. The company will either have to re-domicile to another jurisdiction, or indeed they're going to need to apply to the tax office to become non-resident, assuming of course that they meet the rules of becoming non-resident. The full legislative requirements for a company to be considered non-resident are set out on the slide. However, in simple terms, a company will need to be centrally managed controlled in another country, resident for tax purposes in that country, subject to tax in that other country at a rate of at least 15%, and have a bona fide reason for being resident in that country for tax purposes. The tax office have recently released a practice note to further provide guidance in relation to the application process and to confirm the supporting documentation that will need to be provided along with that application. The practice note is available on the Income Tax Division website. Given that the substance rules have been introduced for accounting periods starting on or after the 1st January 2019, we'd encourage any companies that wish to apply to become non-resident to do so at the earliest opportunity. We would highlight that the tax office is likely to closely review any company making the non-resident application to ensure that the process is not abused. We've also noted that a number of companies have not realised that they have retained their Isle of Man residency status even after becoming resident elsewhere. So we would encourage people to check a company's position. Non-resident Isle of Man. That comprehensive FSA style visit programme undertaken by the tax office. However, that isn't to say that the tax office have not considered the information that they have received, both via submitted FATCA and CRS returns, as well as the compliance return that was submitted to the tax office last year by all regulated entities. As a result of the tax office reviews, a number of generic letters were sent to FIs asking them to reconsider their data where the tax office had identified likely errors. This was commonly due to the FI submitting information to the tax office for account holders who were not located in a reportable jurisdiction, or where the FI had clearly structured their report incorrectly. The tax officer advised us that it received over 130 FATCA and CRS inquiries over the past year, and this has resulted in a high number of FIs making voluntary corrections to their submitted reports. If anyone needs an incentive as to why to take the reporting seriously, penalties totaling £90,000 have actually been raised by the tax office in relation to inaccurate reports. Although these have been significantly mitigated from the maximum penalty, which we understand could have been as high as £80,000. Given that the next filing deadline for FATCA and CRS in the Isle of Man is the 30th of June, we would recommend that time is built into your process to allow for a thorough review of the data to be filed. As you know, a number of tax office deadlines have been extended due to COVID-19. However, to date, the FATCA CRS deadline is not one of them, although we are aware that the IRS have already extended their deadline for the tax office reporting to the IRS, but there is no such extension for CRS purposes yet. But given the worldwide pandemic, we would not be surprised if such an extension did arise, and indeed, the tax office have not yet ruled out that they would grant an extension. However, given that no extension is yet being announced, we would definitely recommend that you continue to work towards the 30th of June deadline in the Isle of Man. Given the number of voluntary corrections made to submitted reports, I'm now just going to spend a few minutes going through some of the common pitfalls that the tax office have seen. The first one is the name of the FI being, The first one is the name of the FI being disclosed on the report. Although this sounds like a silly mistake, I'd imagine that this issue is arising as people are not able to read the XML report that they are submitting to the tax office. The point raised by the tax office is that the name of the FI is often a CSP related entity for a far higher number than they would expect. Firstly, I would highlight this reporting may be correct. For example, a CSP may have their own reportable accounts that need reporting. However, this reporting may also be incorrect. To highlight where the report may be incorrect, I'll go through two examples which I've set out on the slide. If we firstly consider the structure on the left-hand side, we have an Isle of Man company, X Limited, whose shares are directly owned by the UK UBO. On the CRS report, X Limited should be named as the FI, and clearly the UK UBO will be the reportable account holder. However, in the structure on the right, Trust X should be disclosed as the FI on any report. The name of the FI can either be disclosed as Trust X or CSP Limited as trustee of Trust X. The name of the FI will definitely not just be CSP Limited. The settler details will then just be provided on the report as the reportable account. The second common theme highlighted by the tax office are basic mistakes in relation to the account holder's details. This can include the country code, which is obviously key as this dictates the tax authority to which the report is sent, the valuation used for the account balance, and the currency conversion rates. These are all avoidable mistakes with the right review process. Based on the feedback from the tax office, I've created a short list of the key factors to consider when preparing your FATCA and CRS reporting for the 2019 year. The first one is check your entity classification. An entity's classification can change over time. It's therefore important to ensure that your entity remains an FI before considering any reporting. Given that for the CRS, a lot of the grey areas have now been clarified by the OECD's frequently asked questions, care should be taken to ensure that decisions made in prior years in relation to the entity classification are consistent with all of the current Isle of Man and OECD guidance. My second point is check that your base data is correct. If this data is not correct, then obviously there will be integrity issues with any information pulled from this source. Checks should therefore be undertaken to ensure that any residency data is consistent across all of the residency-related fields, and any change in circumstance notifications have been dealt with correctly, and the account holder information is correct. Point 3 is checking the IT search criteria if this is how the XML report is run. As I'm aware of a number of instances where the search reduced the reportable account information has been run by an IT team with little or no FATCA or CRS knowledge. And therefore, the subtleties as to what information needs changing annually within the search criteria has not correctly been identified. A detailed understanding of the IT search is therefore recommended before the search is run. Point 4 is setting out a review procedure to make sure that you spot as many mistakes in the process that have not been picked up from your earlier checks. We'd expect this to include validation checks, as well as an independent review process. Finally, where mistakes are identified, we'd encourage you to engage with the tax office at an early stage. This will help limit any penalties and ensure that any remedial work is as efficient as possible. That is all of the FATCA CRS information that I was planning to cover today. I'd suggest that the main takeaway is to ensure that sufficient time is allowed for the FATCA and CRS process, given that the penalties are now being levied by the tax office for inaccurate reports, and given that the tax office will almost certainly ramp up their review programme as soon as the COVID-19 pandemic becomes under control. Thank you for listening, and I'm going to hand you over to Dave.
Thanks, Claire. So we're now on to the final session, which is for me to talk briefly about the Isle of Man's mandatory disclosure rules. I get all the fun topics. So this arises from a commitment given by the Isle of Man to the OECD some time ago in relation to CRS avoidance. Those of you who are familiar with the rules across the EU in relation to DAC 6, the Directive on Administrative Cooperation, may be familiar with, frankly, what a nightmare DAC 6 is and how complicated, involved, and onerous DAC 6 is across EU member states. The good news, I guess, is that the mandatory disclosure rules that the Isle of Man is introducing, whilst based on or similar to two of the hallmarks within DAC 6, it is much more limited in scope. The bad news for some is that there will be some businesses in the Isle of Man that are caught by DAC 6 across EU member states, and in particular the UK's implementation of DAC 6 can be extraterritorial for certain businesses, but that's not the subject of what I'm going to talk about here. I'm just talking about the Isle of Man's rules that it is introducing. So these mandatory disclosure rules create obligations on intermediaries and also potentially taxpayers, but predominantly intermediaries, to report certain transactions that relate to the hallmarks of CRS avoidance arrangements or opaque offshore structures. Now, when we look at CRS avoidance arrangements, that's schemes and arrangements that have frustrated or sought to frustrate CRS reporting. And then when we look at opaque offshore structures, we're looking at arrangements that have the effect of obscuring beneficial ownership of income and assets. And where intermediaries are involved in arrangements that have these hallmarks, then they have reporting obligations to the assessor. Now, what I would say is that I'd like to think the amount of reporting in the Isle of Man under these rules is likely to be fairly limited. First of all, I'd like to think that businesses have not been involved in implementing CRS avoidance arrangements, but some may have been. And secondly, opaque offshore structures means more than simply you've got a nominee arrangement in place, because of course there is a beneficial ownership register in the Isle of Man. So opaque offshore structures, it does not mean simply that you, a member of the public, cannot see the ownership of the structure. It's more about, can the tax authorities, can the assessor seek to gain information about the ownership of the structure. So it's about, opaque offshore structures is about structures that deliberately aim to obscure ownership from authorities. So as I say, I would hope ultimately that there will be limited reporting in the Isle of Man under these rules. It's worth saying that although the Isle of Man legislation passed through Tynwald in December 2019, it's not yet in force, and it's not clear at this stage exactly when it will come into force. It was anticipated that it would be enforced fairly shortly, I think, but again, as with everything, COVID-19 has had an impact, and there is an OECD angle to this legislation coming into the force. We're slightly ahead of our colleagues in Jersey and Guernsey, where their legislation has not yet passed, but they will be on a similar track in terms of implementation to the Isle of Man, I'm sure. Equally, there is no local guidance yet into the Isle of Man's mandatory disclosure rules. It's not clear how much local guidance will ultimately be published, because the tax authorities tend to be nervous about publishing guidance on initiatives that are based on OECD initiatives, such as CRS. But I would expect that to the extent that guidance is published, it will be published jointly across the 3 Crown dependencies. It's also worth saying that that in certain situations, this legislation is retrospective back to October 2014, a long time ago, but that's only for CRS avoidance arrangements where underlying account values exceed US $1 million. But do be wary of that. And as I say, the principal obligations are on intermediaries, accountants, corporate service providers, and the like. But where there is no intermediary involved or no reporting obligation on an intermediary, then the user, the taxpayer, can have an obligation under these rules. Finally, it's worth saying that inevitably there will be, or there are, penalties under this regime for failing to comply with the rules. That's everything that I wanted to say on the mandatory disclosure rules. It doesn't look like we've got any questions in the chat. Rob, do we know if anything's coming on an email at all?
Nothing in the inbox, nothing in the chat, so I can only assume that implies a very comprehensive series of presentations.
I'd like to think that was the answer. I guess, in which case, I'll wrap up by saying thank you to everybody for joining us today. As Rob said at the start, if you've got any ideas for future webinars, please do let us know. And we will have we will be continuing with this series of weekly webinars, same time each week, and details of the future webinars will be circulated and posted on our website. So I thank you to Rob and Claire, and thank you to all of you for participating. Thanks very much for participating. Thanks very much.